Right on top of this edition of India Tonight, let's talk about the 31st of August. It's going to be a big day for traders. India is going to declare first quarter GDP numbers. A day before that, on the 30th of August, the US is set to declare its Q2 GDP growth rate for this calendar year. Of course, jobs data, inflation numbers, these are the triggers that are around the corner. Already, the Nasdaq is up 31% this year. The Nikkei is up 24%. Here in India, though, the Nifty is barely 6% up. It has been range-bound for weeks now. So where are global markets headed in the weeks to come? Let's explore this with Geoff Dennis, independent Emerging Markets Commentator. He is being joined by Peter Cardillo, Chief Market Economist. Great to have you both with us this evening, gentlemen. Geoff, to you first. Now, earlier this evening, I was talking about how these leading economists around the world, they're flagging off global risks. There are high debt levels they talk about. The weaker growth forecast also being flagged as a concern area. They say these are ingredients of a financial crisis. Now that we know the Fed is going to set their rates, it's going to happen in September. Do tell us where you see the threat to the global economy right now with these heightened levels of debt and the tighter financial conditions that have been brought on by subsequent rate hikes, even as we try to digest the impact of the cues to follow on the growth fronts as far as China, India, US, all of these areas are concerned.
Well, first of all, I think it's worth pointing out that, of course, the US economy is doing considerably better at this stage than people had been anticipating. And therefore, this does take away one of the notable risks, I think, that exist in financial markets. I think the areas where we would have to be concerned about potential quote unquote crisis would be what happens with Chinese growth. Now, obviously, China's been very disappointing this year. The emergence from the zero COVID policy has been very slow, much slower than expected. And that's, of course, been reflected in a very weak performance by the Chinese equity market, a little bit better over the last few days, but generally very weak. Concerns about the property sector. So if we were to see a further sharp decline or slowdown in Chinese growth, I think that would be a source of concern. And then obviously the other one would be that central banks around the world are forced to raise interest rates considerably more. Now, I don't see that happening. I think the Fed may have one further rate hike to go. But inflation in the US, although it may not go down any more this year, it bottomed out, I think, for the year at 3% in June. It's going to come down again further towards 2% early next year. So I think the risk of a major spike in interest rates from here is probably relatively small. But those would be the two concerns that I would be most worried about at this stage.
The risk areas, like Geoff is pointing out, Peter, when it comes to the uncertainties in the markets, and markets typically don't like uncertainties, tell us what do you see as the biggest risk right now to global growth and how that's going to impact investor sentiment?
Sure. I think there are two risks here. One, the global central banks over-tightening. But I also believe that the Fed is probably over with tightening, and I think there's a good chance that in September they might actually hold the line if we see some good news on inflation. In fact, Thursday we'll have the PCE, and if we see core rate come down by 0.2%, that would take us just slightly under 4% year over year. And that would be good news for the Fed. And then, of course, we have the labor market report. There again, it's not so much the creation of jobs, but again, inflation at labor inflation that's really important to the market at this time. And there again, I think we'll see, hourly wages rising modestly, maybe by 0.3%. And then the big other factor for me is China. China is in a very, very tough spot. In fact, there's a good possibility that the numbers are actually weaker than we've been hearing about, and that means that it may not be a textbook recession, but certainly the economic activity in China is among the Chinese population is stagnant and feels like a recession.
That's
And
right.
that obviously boomerangs around the globe. So China, I think, is a big problem,
Yes.
and it could force the global economy into a light recession.
So, Geoff, would you agree with the concerns over China? Because as far as India is concerned, we were hitting these historic highs, and then we've stopped growing as far as our markets are concerned. And now the Nifty has been trading in a range. There have been concerns that the bond yields spiking in the US. That means that there will be more FPI outflows in the days to come. Do you see that happening? And if that is the case, how is that going to impact emerging markets like India?
See that being the case at all at this stage. If you look at the weakness of markets in August, and well, we've obviously recovered over the last 2 or 3 days nicely, but if you look at the weakness of markets in August, that was down to two things, I think. One was the China story that both Peter and I have discussed already, and secondly was the sharp move higher in particularly long yields, 10-year yields up above 4.3%. Well, this morning with the very weak JOLTS data, the jobs opening data in the US, both the 2-year and the 10-year are at 2.5-week lows. And so somewhat, should we say cautiously, I would argue, it looks like this spike in yields it may well be over. And if that is the case, that's going to be very beneficial for the emerging markets down the road. Now, obviously, obviously, it's always been my view. I think what you really do need to see to really help emerging markets here is not just the sign that maybe we are at the peak, maybe of short rates and certainly hopefully of long rates. Then you would want to see the dollar going lower. Dollar's been strong again lately, and that a weaker dollar would help that as well. Now, in terms of India's performance, now India's not done that badly this year. It's up 5% this year. That's a better performance than EM overall, not by much. Although EMX China is still up around 8 to 9%. So you could argue versus EMX China, India has been an underperformer. But if all of this comes to play out the way I'm anticipating, which is, as I say, close to peak yields in the US, Fed done or almost done, dollar probably beginning to drift lower from here. The great Indian growth story that is there, notwithstanding the regular concern about valuations, I would fully expect to see some of that FII money coming back to India over the next 6 to 12 months, with the risk, the danger that this won't happen would simply come from much, much stronger inflation down the road, pick up again in US inflation, which I just don't see happening. So, yeah, I think we've seen the worst of the yield move at this point, and I think that's very bullish for emerging, and I think it's very bullish for India.
So among the emerging markets, from what Geoff is saying, as far as India's resilience is concerned, and perhaps the FIIs are going to look at the Indian markets more favorably. Peter, would you agree with that perspective? There are growth concerns as far as the financial ecosystem is concerned, and we have seen those red flags coming through the ratings for some of the regional US banks. Now, this does cause a certain amount of upheaval in the financial ecosystem elsewhere. How systemic do you think this could be, and how much damage could that be seen even in emerging markets and our financial stocks?
Well, I just want to touch upon India. I agree that, India's economy has been resilient, just like the United States, you might say. And so that's good news, but I'm not too sure about other emerging markets. As far as the banks are concerned, just a few moments ago, we heard that the regulators have unveiled a plan where they're forcing regional banks to raise their debts in case of failures. And, I think that's positive news. In fact, that could be one of the reasons why we saw a spike in the averages, especially in Nasdaq. So, I really don't think that we're headed for any major banking crises,
Right.
Domestically or globally. But again, it goes back to high rates,
Yes.
and what the impact is for the global economy.
Right. We will keep watching what happens with all these cues coming in on the manufacturing front in China and the Eurozone in UK. Of course, India is going to have those numbers coming out, and it's going to have a significant bearing on how these markets, the equities, are going to be looked at in times to come. But of course, more recently, of course, we are going to see all that data do its bit. The Fed's action is definitely going to have a bearing. Thanks very much, Peter and Geoff, for joining us with your perspective on this edition of India Tonight.